In the third session, I gave 7 practical steps to get out of debt. And if you weren't here, I'd always encourage you, and even if you were here, to go through those steps, because they do take a while. We can go through them in one evening, but they may take a few years, several years, to really implement them all. Tonight, I'm going to talk about budgeting, and in the second half, investing. So let's talk about budgeting now. The objective of this session is to learn how to develop and implement a budget. Now, if you don't like the word budget, call it a cash flow plan, call it a spending plan, whatever you like. It's just a real practical tool to help you plan your finances. And there's actually 40 references in the Old and New Testament to planning, and most of them come out as an admonition, and we'll be dealing with some of them, like the parable of the tower is the memory verse tonight. Bottom line, God admonishes us to plan ahead, and planning your finances can best be accomplished with a budget. The purpose of budgeting, and if you forget everything else I say tonight, just remember this. The purpose of budgeting is to ensure that you spend less than you earn, so you have a surplus each month to pay down debt and save for future needs. Your monthly cash flow or your monthly budget is really almost it's a cornerstone to your finances. It's going to determine whether or not you're developing some savings to pay for future needs or you're not. If you sort of fly by the seat of the pants like most people do, you operate based on gut feel or personal desires, the probabilities are very high you'll spend a little more than you earn, and you'll accumulate debt rather than accumulating some surplus to pay down debt and to save for future needs. And the other thing I find inevitably, it's interesting, often when organizations are short of money, they'll talk about tithing, and tithing is very important. But what I find is as Christians inadvertently, unintentionally spend a little more than they make, and they start to accumulate debt, the giving goes down, because when you come to the end of the month and you got a choice between making your mortgage payment or giving to God's work, people will be making their mortgage payment. And we shouldn't be in that kind of position. We should be managing the cash flow every month as God directs and making sure that we are spending less than we earn. Actually, what you need to do is live below your means so you have a surplus to provide for future needs, and that's just so critical. So a proper budgeting system will allow you to make wise financial decisions and eliminate the guesswork. In Proverbs 24:3-4, it says, "By wisdom a house is built, through understanding it is established, through knowledge its rooms are filled with rare and beautiful treasures." We need to understand where our money is going. I find most couples, when we sit down with them, or even individuals, they'll say, he makes X, she makes Y, you add it together, it's a reasonable income, and they have no idea where their money's going. And so one of the first things I encourage them to do is go through my form number 6 and track their expenses for a few months, or if they have their records, to complete the form. If they do know where the money went, if it was paid with debit cards, and they have a track record of it, to complete the forms and see where their money is going. It's amazing when people start tracking expenditures, they become quite surprised where they are spending money and how much they are spending money in certain areas, and sometimes it's discretionary areas. God instructs his people, be sure you know the condition of your flocks, give careful attention to your herds. We don't have herds and flocks unless maybe there's people in the farming business here. But the modern day application of that would be know your assets, your liabilities, your expenses. Know what your housing expense is. I've seen so many individuals and couples when they decide they feel led to go and buy a house, and that's a good thing to do, nothing wrong with that. They'll let the bank decide how much they're going to spend on a house. What they'll do, they'll go to the bank, and he makes X, she makes Y, and the bank applies its formula. Normally they're applying a maximum formula, and they'll say, okay, based on that, I think of a couple, for example, recently, a young couple, combined gross pre-tax income, the bank offered them a mortgage of $350,000. And the mortgages are only being offered that high because interest rates are so low now. But if interest rates ever go up again, which we see they're starting to go up, and the odds are they're going to continue to go up for some time, it's people are going to get squeezed, they're going to get hurt. So you cannot let the bank make the decision for you. You got to make sure that you make it based on your monthly cash flow and based upon God's will for your life. And even if you get approved for a certain amount, that doesn't mean you should go out and borrow that amount. Maybe you should borrow something less. Do whatever God directs you to. I mean, as Paul said, godliness with contentment is great gain, and we brought nothing into this world, we shall take nothing out of it. Proverbs 21:5 is one verse that admonishes us to plan ahead. The plans of the diligent lead to profit, as surely as haste leads to poverty. In the parable of the tower, Christ basically said, if you don't plan ahead, you're foolish. So the budget is a key tool to do it. And like I say, don't like that term, call it a cash flow plan or a spending plan. So here's our recommended memory verse for tonight, the parable of the tower in Luke 14:28-30, where Jesus said, "Suppose one of you wants to build a tower. Will he not first sit down and estimate the cost to see if he has enough money to complete it? For if he lays the foundation and he is not able to finish it, everyone who sees it will ridicule him, saying, 'This fellow began to build and was not able to finish.'" So are we ready to give that a try? I'll flip back. Okay, suppose one of you wants to build a tower. Will he not first sit down and estimate the cost to see if he has enough money to complete it? For if he lays the foundation, is not able to finish it, everyone who sees it will ridicule him, saying, "This fellow began to build and was not able to finish." That's great. A number of people had it. I know that's one of the longer ones. It's one of the harder ones. As you know, I'm such a believer in getting God's word into your mind. If you want to think the way God thinks about money and material things, you've got to reprogram this thing up here, because you've been bombarded with so much from the media in the world that's contrary to God's way of thinking. And so you've got to be, as it says in Joshua, meditate on his word day and night, and to make sure we're thinking God's way. The first assignment we had this week was to develop your own budget. I trust that you were able to access the budgeting system. My budgeting system is available from our website. It's free. It's as a download. It's Excel based. I will be demonstrating it tonight, and you can see the website address there. And I'd also mention this. I'd really encourage you to give it a try. If you run into problems, one of the ministries we provide through my firm, there's 7 people that are trained that have a good understanding of God's financial principles, and also budgeting as well. And if you give it a try, especially fill out forms 1, 2, 3, and 5, send it to us. We'll have a look at it, and we're more than willing to sit down with you and your spouse if you're married and help you develop a monthly budget or a cash flow plan. It's just so important. I know for some people this is not natural, but once you get the hang of it, it's really not that hard. So what I'm going to do now is I'm going to flip to the Excel. I'm actually going to demonstrate the budgeting system. And first of all, before I demonstrate it, are there any questions so far or comments?
Tom, are you going to talk about wills?
I hadn't planned to. It's more of a legal matter. I can mention them briefly, that it is important to have a will. If you don't, the government ends up deciding where your assets go, and the government even ends up deciding who becomes the guardian of your minor children. So it is critical to have a will. I do that in a series, a session I call Biblically Based Estate Planning. I talk about it a bit. I don't get heavy into the legal side, but just the importance of it. It is very important to have one.
Very few people understand the legal implications
Yep.
if they don't have a will for their children.
Yep.
And it really affects all the relatives and everybody else.
I agree. There's a lot of negative consequences to not having a will. If I go into them, we'll end up talking about wills for a half an hour, but I'm glad you brought that up, because it is something that's very important. And doing the will, you've got to take a biblical approach to estate planning. Very, very, very few people do that. Very few Christians do it, because they really don't know what the Scriptures say. I'm going to demonstrate the system now, and I'm going to just put in some sample numbers. Let's suppose for this couple they got $1,000 in their checking account. Let's suppose they've got $10,000 of investments, perhaps in mutual funds or a GIC. Let's estimate the value of their real estate at $350,000. In their retirement fund, we'll just estimate that he has $40,000 and she has $20,000. And then going down a little further, these are just estimated amount. You notice I always round to the nearest dollar. It just makes it a whole lot simpler. Credit cards. This couple is doing what most people do. They're running a balance on their credit cards, and $20,000 to $25,000 is quite common. Very, very common when you add up all the credit cards. We've seen people with over $100,000, but 25 is very common. So that's what this couple's doing. They're running a balance on their credit card. They're paying the minimum payment each month. They think that's fine. They don't understand, for example, at $25,000 of a balance, say you make that a lifestyle, you're incurring $5,000 a year of interest. That's really just wasted money. And let's say you make that a habit, you do it over 50 years. That's $250,000 of God's money that's wasted. And I find so often people say to me, yeah, but we bought this because it was a great deal. But if you factor in all the interest they pay, it wasn't such a great deal. And the other comment I always make is, Even if something is a great deal, if you cannot afford it, you shouldn't buy it. So personal loans, typically for a lot of people, they're spending more than they're making, and they end up borrowing some money from mom and dad or relatives, brothers, sisters, friends, that kind of stuff. This couple here has done what most people do. They have a personal line of credit. Personal lines of credit and credit cards, there's nothing wrong with them in and of themselves, but they create a tremendous temptation to enable you to spend more than you're making and accumulate debt. And we see it so often, seeing the PLCs at much higher amounts than that. In this situation, their mortgage is a couple $100,000. Now here it's not too bad, but this could be a couple. I see this so often. They bought their house 20 years ago. It cost them $150,000. Today it's worth $400,000, and their mortgage is $300,000. And you wonder, how in the world did that ever happen? It's because they've been living a lifestyle that's more expensive than what they can afford, and using initially credit cards, personal lines of credit, and then eventually consolidating the debt into their mortgage. Because banks, if you got real estate and you got good equity in your real estate, they love to loan you money. So the temptations that we have today compared to, say, 50 years ago in this country are phenomenal to get into debt. It is so easy to get into debt. So in this situation with this couple, we've put everything down. By the way, you don't need to list any assets if you don't plan to sell it, if it's a personal asset. But if you have some assets that you could sell, do list them on this. It doesn't have to be precise, but at least have an idea of what your balance sheet looks like. So even though this couple here, they do have a net equity of $116,000, which looks pretty good, what you're going to see with the couple I'm demonstrating, which I've seen probably 1,500 times at least, is going to be very typical. They have a negative monthly cash flow. So I guess just a question, anything on this, any words of wisdom that you would, anything you could think that this couple could do to sort of help their financial situation, just from those numbers?
Depending on the interest rate spreads, they should use their PLC to pay off the balance that they're carrying on their credit cards,
Yep.
and perhaps the personal interest loan.
It's certainly, there's nothing wrong with using a PLC or any form of debt with a lower interest rate to pay off the credit cards. But what I always tell people, and you're smack on, they should do that, is to understand that treats the symptom, not the problem. The problem is you're spending more than you're making, and you've got to deal with that. If you don't, and you keep using the credit cards the same way, you're just going to have more debt, and it's just going to keep accumulating. And that's certainly one thing they could do is certainly you want to get rid of the credit card debt. It's very expensive. One of the first things I would say to do is to sell the investments and pay off the credit card debt. And then certainly, arranging some other types of financing to get rid of the rest of the credit card debt, whether it's a PLC or personal loans, would be fine. So thanks for that comment. That was a good one. With this couple, I'm just going to put in, this is just their average after-tax income each month. The husband works full-time, the wife works part-time, and going to assume $5,500 a month. I'm now going to go on to, that was on form number 2, by the way. So our form number 2 lists out the revenue. It's a pretty simple form. Form number 3 is a very important form. I call this non-monthly expense planning. Most people, when they put together their budget, they usually list out property taxes, utilities, and certain expenses that they incur every month. But they forget about the expenses that incur once a year, like insurance, like house maintenance, sometimes property taxes, auto repairs and maintenance. There's a vacation. There's a lot of expenses that come up, say, once a year or twice a year. A vacation's a good one. Very, very few people will save for their next vacation. So what happens is when the vacation comes up, it goes on the credit card, and it puts them behind the 8 ball. So what this form does for you is if you key in the total estimated cost for the next year, these numbers don't have to be precise. It's your best estimate based upon what you spent in the past and what you think you'll spend in the future. I'm going to just put in a few sample numbers. It's very common for a house to have $1,200 a year of maintenance. One of the things with repairs and maintenance for a house or car, they don't always occur at once. And so often people will say to me, especially for a car, well, how can I put in something in my budget for auto repairs and maintenance? If you want a rule of thumb, $1,200 per car. So we're going to put in $2,400 for the year because they have 2 cars. People say with me, well, we don't really know that. But the answer is, at least if you put something aside, even if you do have a big repair, that's a surprise. You're going to have some money for it, even if you don't have it all. And often, over the long haul, over a few years, you will have enough money. Anybody here ever have a surprise automobile repair you didn't expect? Pretty well everybody, right? If you don't set something aside for that in your monthly cash flow, you'll be forced into debt. at some point. Property taxes for this couple, we're estimating $3,300 a year. And let me just say this, if your taxes are paid monthly with your mortgage, you don't have to do that. House insurance, $600 a year. Now, you'll see what's happening here. For the house maintenance, for example, I put in $1,200. The formula, it automatically calculates the monthly amount. And you're going to see in a minute what I'm recommending is that for house maintenance, you set aside $100 per month in a savings account for maintenance, and then when those costs come out, you're going to have some money to look after some of those costs. If you don't do that, you're more than likely going to end up being forced into debt at some point. Same with automobile replacement. I mean, does anybody here think your automobile is going to last forever? Exactly. Do you think you're going to have to replace it one day? We know that. But stats show that it's only like about 5% of the population that will actually pay cash for an automobile. Very, very few. Most people finance it through a lease or through a loan. And even if it's a, quote, 0% loan, in the appendix, if you go through that, Mr. Borrower versus Mr. Saver, the example I give, you're still a lot better off to save for your future automobiles. Now, this couple should be saving for an automobile, and I'm suggesting saving for it over 5 years, that's 60 months. It could be 48, it could be whatever amount, but they don't have enough money to do that, so they're not doing it. Automobile insurance for the 2 cars is $2,400 a year. They should be setting aside $200 a month in order to have the cash to pay for that. Vacation, they plan to take a vacation next year for $1,800. So again, you put that in you can see it's automatically calculated. It's $150 a month they should be putting aside. Now, they should be putting aside some money for retirement and children's education, but they're not doing that. Healthcare, they estimate it runs about $1,500 a year, so they should be setting aside $125 a month. Christmas gifts and other gifts, $900 a year. And again, you can see, and other is the general category. I'm going to put in $3,600. That's $300 a month. The reason I'm putting in that much, that's the category, that's sort of the catch-all, expenses that don't fall into anywhere else. So this is the form number 3, the non-monthly expense planning. This is such a critical form because if you don't do this, look what it adds up to for this typical couple, $1,475 a month that they need to set aside for non-monthly type expenses that come up once a year or maybe twice a year. And if they don't do that, they'll end up being forced into debt, and they'll get behind is what will happen. Feel free to stop me anytime as I move forward through these forms. This, I'm going to go to the next one, is form number 4. This is a savings account allocation. When you set aside this amount of $1,475 a month, you need to account for it. And the reason you need to account for it is you can see automatically, you see the numbers I calculate here that are calculated automatically. There's a lot of stuff in this program that's done automatically. Like the house maintenance of $100 a month, the property taxes of $275 a month, it's automatically transferred up here. So what you do, and you'll see later when I get to Form 6, when they get paid, we're actually going to transfer $1,475 across and put it into the savings account. And once we do that transfer, what will happen is this just basically gives an accounting for all the money that's there. I'll jump to form number 6 for a minute. I'll show their revenue of $5,500. That's their net pay. I'm assuming they get paid once a month to keep it simple. If you're paid twice a month or 4 times a month, you can just key in the numbers appropriate. And immediately we key in here $1,475 as a transfer to the savings account, and you'll see that it shows up on this form over here. Now, here's what I find happens so often is that couples will say, okay, can we afford that new thing, whatever it is, in the house, and they'll think, well, it's going to cost $800. Honey, we have $1,475 in our savings account. Sure, we can afford it. We even have to have the cash. We don't have to take out any debt. But the problem is this: if they're saving for some anticipated non-monthly expenses, out of that $1,475, if you go down here to the bottom, you'll see that it's all accounted for, because the funds in the savings account, this is calculated automatically, is $1,475. The designated amounts is $1,475. The undesignated amounts is 0. So in this case, all of the money that's been transferred is designated for future expenses, so you shouldn't touch that money in your savings account, even though psychologically you may think that you can afford to buy whatever the additional item is that you're thinking of buying. And that's probably the most important aspect of form number 4. Now, by the way, I had a pastor friend. He would actually, if you go across here, there's about 10 categories in the different types of expenses. He would actually have 10 different bank accounts, and each time he got paid, he would allocate certain amounts. And, some might joke about it. I used to tease him about it, but, it worked. And what's amazing, here's a guy with 3 kids, one family income for many, many years with a modest income. They're debt-free. They've paid off all their debts. They're in good shape for retirement by his late 50s, and all of his kids, all 3 of them, completed university with no debt. And that's so unusual, but just he was a really good money manager. And by the way, the inheritance that he's given his kids in demonstrating how to manage money God's way, I think is way more valuable than giving them a whole lot of money. We see it in our practice because we do some entrepreneurial type businesses, and one of the worst things actually that can happen is just to give a young person a whole lot of money. You need to pass wisdom on first before you pass on assets, that's for sure. The next form is form number 5, and in this form here you'll notice some of the expenses. This is the summary form. Some of the expenses come out automatically. For example, property taxes came from form number 3, the non-monthly expenses. Maintenance came. You'll see the numbers are already here. So all you got to fill in is the balance. So I'm going to put in, they've tracked their expenses for a few months, and they've noted they're only giving about $100 to the Lord's work, and not a surprise because they've been spending more than they're making, and they're accumulating debts. So their mortgage, I worked it out, is $1,013. Electricity, let's assume it's $275. Gas, running about $250 a month. Water is about $75 a month. Now, I should change the title on this, but this is really not, it's not just telephone. I call it telecommunications. That's your cell phone, your internets, and of course, almost everybody has a cell phone today, iPhones, smartphones, and that kind of stuff. That expense is a lot more than it ever used to be. So you got a housing expense here of $2,338. Food, they've got 2 teenagers, and they spend $800 a month. It's amazing what teenage boys can eat. I know we had our nephews to our cottage once, and we were amazed with the food they could eat. It was astonishing. I mean, I stood in awe. I really did. And my wife likes to bake, okay, and she loves dessert. And I can't digest too much of it because I got something called IBS. But these young guys, man, they had it for breakfast and lunch, and they didn't gain a pound, of course. Now, that isn't going to happen to us, right? But at least not to me. But it can get expensive, especially depending. Insurance, this came over from the Schedule 3. Gas and oil is $400 a month. They got 2 cards. Their credit cards, they're making the minimum payment, which is about $500 a month. And their personal line of credit, they're just paying interest on it. It's about $200 a month. And if you go to the top here, eating out, they're spending about $300 a month eating out. Sports club, they're spending about $100 a month. Clothing, they're spending about $300 a month as they track their expenses. Life and disability insurance, it's $125. Education is $150. And so once we assemble this all together, this is what I find happens so often. They got a deficit of $863. Their total expenses is $63, and $5,500. The exact numbers aren't that important. I'm trying to demonstrate the concept. We find more often than not when we sit down with an individual or couple, and they actually look at the money that they spent in the last year or two, on an average monthly basis, typically they're spending more than they should, and they're accumulating debt.